Every candlestick tells a story, a battle between buyers and sellers. But if you can't read that story, you're trading blind. In this video, we will demystify candlesticks and give you the foundational knowledge to start reading price action like a pro. Let's dive in. A candlestick shows how price moved during a specific time period, whether that's 1 minute, 1 hour, or 1 day. Each candle represents 4 key prices: the open, close, high, and low. The thick part is called the body, and the thin lines above and below are wicks, or shadows. Together, they give us a quick visual summary of what happened in that period. The body illustrates the battle between the opening and closing prices. If the closing price is higher than the opening price, the body is typically colored green. This represents a bullish period, where buyers were in control. If the closing price is lower than the opening price, the body is typically colored red. This is a bearish period, where sellers dominated. Each candle, whether red or green, reveals the tug-of-war between demand and supply. The wicks are just as important. They show the full range of price exploration during the period. The top of the upper wick marks the highest price, and the bottom of the lower wick marks the lowest. Long wicks indicate that price was rejected at those levels, telling you where resistance or support was found. Candlesticks aren't just visuals. They show emotion. A long candle body means strong momentum, either buyers pushing up or sellers pushing down. A short body shows hesitation or balance. A long upper wick means sellers forced the price down after buyers tried to push higher. And a long lower wick means buyers stepped in and defended support. Each candle gives clues about who's winning and who's losing the fight. While single candlesticks are informative, their real power emerges when you see them in sequence. Here's how to read them together. If you see a series of green candles with higher highs and higher lows, that's an uptrend, showing strong buying pressure. If red candles dominate with lower highs and lower lows, the market's in a downtrend. A doji candle, where the open and close are almost equal, shows indecision and often appears before a reversal. Bullish engulfing pattern. This is a potential reversal signal at the end of a downtrend. It occurs when a small red candlestick is followed by a large green candlestick that completely engulfs the body of the previous red one. This suggests a powerful shift from selling pressure to buying momentum. Bearish engulfing pattern. This is the opposite. Appearing at the top of an uptrend, a small green candlestick is followed by a large red candlestick that engulfs it. This indicates that sellers have overwhelmed the buyers and a downturn may be starting. These patterns help traders spot entries and exits before big moves. Candlesticks tell you what happened, but trading volume shows how strong that move really was. A breakout candle with high volume is more reliable than one with low volume. So always read candles together with volume. And we'll explore this in detail in next video. Now you can read the language of crypto charts, candlesticks. If this helped, hit like, subscribe, and turn on notifications. And don't miss the next episode. Trading volume, the fuel behind price movements. See you at Byte Crypto Academy, where you master crypto, one byte at a time.